It's Monday, 19th of January, 2026. Welcome back to your news update on Blip Brief, crisp, but almost everything updated every weekday.
Let's jump straight into it, because if you're watching the Indian market tickers today, you might think your screen is glitching.
Yeah.
We are seeing a divergence between economic reality and stock prices that is frankly confusing.
It really is. It feels like we've stepped into some kind of mirror dimension. The earnings reports we have look sluggish by any traditional metric.
Sluggish is putting it mildly.
Yet the market seems to be just humming a happy tune.
It's that classic bad news is good news dynamic, but yeah, dialed up to 11. Let's start with the IT sector.
Okay.
The briefings over the weekend, they showed aggregate net profits for Q3 were weak. We're talking mid-single-digit growth.
And in the glory days of Indian tech, that kind of report card would have sparked a huge sell-off.
Exactly. Mid-single digits is basically stalling. But then you look at the board today, Infosys isn't selling off.
No, it's defying gravity. It's surging.
Infosys is up 5.65%. I mean, that's a massive green candle for a stock that size. And it's not alone. Tech Mahindra has gained 5.17%.
So help us bridge this gap. Why are investors piling into these stocks when the actual report card shows a clear lack of growth?
It's what the analysts are calling looking through the valley. The market has just decided collectively that this earnings bog is the bottom.
So they're not buying for what they did in Q3.
Not at all. They're buying them for what they think the U.S. Federal Reserve is going to do next month.
Rate cuts. It always comes back to the Fed.
Always. The logic is bad earnings mean the economy's cooling. A cooling economy forces the Fed to cut rates. Lower rates mean U.S. companies spend more on tech.
And therefore, Indian IT booms 6 months from now. They're front-running the recovery.
Precisely. But here's the catch. This is where the market gets fickle. While it's forgiving the IT sector, it is punishing the energy sector for something else entirely. Look at Reliance.
Yeah, RIL is having a rough Monday. It slid nearly 5%. Now, their profits were also largely flat, similar to IT, but the reaction is completely different.
Because with Reliance, it's not just about the numbers. It's about the narrative. You have these reports swirling about Russian oil shipments.
And the company denying them?
Right. And markets hate uncertainty far more than they hate bad math. When you have a geopolitical cloud hanging over your primary business, investors get skittish.
So IT's problem is cyclical, but Reliance's problem feels geopolitical.
That's the divergence in a nutshell. One is being bought for the future, the other is sold because of present risk. And right in the middle, holding the whole thing together.
The banks.
The banks, the structural spine of the market. While IT rallies on hope, the banks are actually delivering double-digit profit growth. That creates a kind of floor for the index.
But even in banking, it's not a clean sweep, is it? I was looking at the breakdown, and it seems like the regulator is spoiling the party for a few players.
It's a fascinating dynamic. You've got State Bank of India, SBI, up 1.36%. HDFC Bank is also in the green, up about 0.5%.
But Kotak Mahindra Bank is down 0.65%.
And this is all tied to the Reserve Bank of India's recent audits. The RBI has been very active flagging deficiencies in what's called priority sector lending, or PSL.
And for anyone who doesn't track this daily, PSL is the mandate for banks to lend a certain amount to agriculture, small businesses, specific sectors.
It's a social obligation, really. And the RBI found that heavyweights like HDFC Bank and ICICI had some compliance gaps. Normally, a flag like that would cool off a stock price.
But HDFC is up.
Which tells you how strong the underlying profit growth is. Investors are willing to look past the, regulatory noise. They're betting a slap on the wrist won't derail the earnings train.
A calculated risk. They're assuming the fine is cheaper than missing the rally.
Exactly. But notice the public sector giant, SBI, is up more. When the regulator gets tough, some investors drift towards the state-owned banks. They're seen as a bit safer.
All right, let's shift gears. From finance to the factory floor, the auto sector. This feels like a tale of two completely different economies.
It is a complete split screen. If you look at the ports, autos are booming. If you look at showrooms in the domestic market, it's a very different story.
The export numbers were what caught my eye first, a 24% jump in 2025.
Massive. Indian auto exports are up 24% year on year. Made-in-India cars and two-wheelers are finding homes in Africa, Latin America. It really validates that manufacturing hub idea.
But then I look at the stock tickers. Maruti Suzuki is down 1.78%. Asian Paints, which is a proxy for housing but also autos, is down 2.25%. What's the disconnect?
It all comes down to the customer. The export boom is great, but for a company like Maruti, the bread and butter is still the Indian middle class.
And the Q3 assessments are showing persistent stress there.
That's the signal. When Asian Paints drops, it suggests people aren't repainting homes or buying new vehicles. It points to soft retail demand. So investors are saying exports are nice, but they don't offset the slowdown at home.
It's that K-shaped narrative again. The external-facing part of the economy is flying, but the internal consumption engine is sputtering.
And you really want both engines firing. Speaking of precarious situations, we have to talk about the geopolitical elephant in the room.
Trade bazooka. I honestly thought I was reading a satire site this morning. We're really talking about a trade war over Greenland.
It sounds like a comedy script, but the financial implications are deadly serious. U.S. President Trump is in a standoff with the EU over their refusal to entertain selling Greenland.
And so, tariffs.
Threats of sweeping tariffs on Denmark, Sweden, France, Germany. And the EU isn't backing down. They're using this term trade bazooka, which implies massive retaliation.
And the first shots are already fired. A 25% tariff on semiconductors.
That's the critical piece. You can laugh about Greenland, but you cannot laugh about a 25% tax on chips. That's the brain of the modern economy.
It inflates the cost of everything. Smartphones, laptops, those cars we just mentioned.
It ripples through the supply chain instantly, just rattles global sentiment. But here's the fascinating nuance in all this. Look at China.
You'd think a global trade war would hammer them, given their own economic issues.
And yet their tech stocks are booming today. We're seeing this phenomenon of sentiment decoupling.
Decoupling, so they're just trading on their own internal logic.
Exactly. While the U.S. and EU fight over islands, Chinese tech is rallying on actual domestic breakthroughs. New AI models, successes in commercial rockets. Investors there are focused on innovation, almost ignoring the macro gloom.
It's ironic. The global system is fracturing, and the one place everyone called uninvestable is suddenly a tech outlier.
It just shows that innovation can sometimes overpower macroeconomics, at least in the short term. But for the global investor, when you have a trade war escalating, where do you hide?
You head for the bunker. And in finance, the bunker is usually made of metal.
Precious metal. We are seeing a textbook safe haven rush. Just look at silver.
I had to double-check this number, up 13%.
13% in just 13 days. That's a vertical line on a price chart. That's panic-driven buying.
And gold is right there with it.
Gold is hitting records. Yes, you get tiny intraday dips of, say, 0.02%, but the overall trajectory is straight up. This is directly tied to the trade war fears.
It makes perfect sense. If the dollar and the euro are being used as weapons, you don't want to hold them. You want an asset with no counterparty risk, gold and silver.
It's the fear index made real.
So we have fear in metals, hope in IT, confusion in autos, a complex mix. But amidst all this, some big corporate deals are still being discussed. Sun Pharma is making headlines.
It's a bold move. Sun Pharma is evaluating an acquisition of the U.S.-based company Organon. We're talking billions.
That seems counterintuitive, doesn't it? With all the trade tension, why double down on the U.S. market?
It's about portfolio diversification. Organon is a specialist in women's health and biosimilars. This would give Sun Pharma a massive footprint in a lucrative segment. It signals that the corporate appetite for growth is still there, despite the political noise.
Speaking of growth, the Indian government has a new plan for roads, or a new plan for paying for them.
Yes. The center is planning to bid out half of the national highway projects for fiscal 2027 under the Build, Operate, Transfer model, the BOT model.
So the private developer builds the road, collects tolls for a set period, and then hands it back to the government.
Correct. It pushes the execution and revenue risk onto the private sector. The signal here is that the government believes the private sector's appetite for risk is back.
It's a vote of confidence in the economy's long-term growth. But there's always a but. All this growth talk runs straight into the wall of inflation.
The ghost that won't leave. Wholesale inflation turned positive in December.
That's the WPI.
The Wholesale Price Index. It's often a leading indicator for the consumer prices you and I pay, and it's being driven up by food and manufacturing prices.
And this circles right back to our very first point, doesn't it? About the IT sector.
It closes the loop perfectly. The IT sector is rallying because it expects rate cuts. But if inflation is creeping back up, the central bank cannot cut rates.
So the market is pricing in a rate cut party, but inflation might just shut it down.
That is the fundamental tension of this entire week. Growth versus inflation. Hope versus data.
Well, let's pivot from that headache to our innovation of the day. You found something that sounds like it's straight out of science fiction.
I did. We're talking about the phonon laser.
Phonon with an N, as in sound, not photon with a T.
Exactly. A normal laser aligns particles of light photons. This new device does the same thing, but with particles of sound phonons.
Wait, sound particles? I thought sound was just a wave.
Well, in quantum physics, it can be described as both. Think of this device as creating incredibly controlled, synchronized vibrations on a microchip, a laser beam, but made of sound.
Okay, so we have a sound laser on a chip. Is this just a cool lab trick, or does it actually do something useful?
It solves two huge problems. The first one is in medical imaging,
Better than X-rays.
safer than lasers. An optical laser, a light laser, can cook tissue if you're not careful. It transfers heat. A sound laser could image deep tissues with high precision, but without that thermal damage.
That's huge for diagnostics, and you mentioned a second application.
And this is the business angle, miniaturization. We're hitting the physical limits of how small we can make electronics. But phonons, these sound waves, have a much shorter wavelength,
Meaning you can pack the components tighter.
much tighter. This technology could let us build components that are significantly smaller and more energy efficient than what we have today.
So the smartphone of 2035 might run on sound waves.
Or at least the communication on its chips might. It's a breakthrough that could, 10 years from now, define the entire semiconductor industry, assuming we aren't still fighting trade wars over chips by then.
Let's hope not. So let's try to tie this all together for the listener. It is a messy Monday.
It is a market of contradictions. You have the IT sector rallying on the hope of future easy money while ignoring its own weak earnings.
Then you have the banking sector acting as the reliable workhorse, even with the regulator snapping at its heels.
And you have the real economy, the auto sector flashing a warning sign. Export strength, but domestic weakness. That gap is widening.
And over all of it, this geopolitical absurdity of a Greenland trade war, which is driving a very real, very dangerous rush into silver and gold.
So the takeaway for anyone listening is don't chase the headline, chase the logic. If you're buying IT, know you're betting on the Fed. If you're buying banks, you're betting that growth beats regulation.
It's a time to be selective. A rising tide is not lifting all boats right now. It's lifting some and capsizing others.
Precisely. Verify your thesis before you act.
And on that note, we'll wrap up today's update.
And just before you go, a quick note. This deep dive commentary was put together using advanced AI. We always strive for accuracy, but please do cross-verify any crucial information yourself. Your informed decisions are what matter most.